I told you earlier today about the dark day on Wall Street. No doubt a lot of you are checking your 401ks and investments, worried about your future. We're joined on the floor by Brad White, a senior wealth advisor who's worried about your future too. Brad, walk us through these tumultuous days. We talked about it earlier. Why is the market reacting like this today? Because this was really a big swing.
Yeah, tough act to follow after the Gerber baby, but we're going to do our best here. Huh? So there's a couple key lessons that you just really need to understand about how the stock market works that's going to help explain what's happening. The first is the stock market is a leading indicator for the economy, not the other way around. What that means is the stock market's not ever trading off what's happening today. It trades off what it thinks will happen in the future. That's important because a lot of people certainly realize the market's down 13, 14, 15% year to date already, and they're hearing about prospects about a potential recession that the U.S. might head into. So I'm already hearing chatter from clients and other people like, well, Brad, if it's already been this bad and we haven't even gotten to something like a recession, how much worse can it get? I just want people to remember that obviously a lot of that is baked in. You just can't forget that the market's not oblivious to the fact that we have rampant inflation, that interest rates are rising, and that, yes, we've got this potential to push it into a recession territory. The perennial question is always how much of this is baked in, right? So if inflation is peaked and things don't get out of control, we don't hit a recession, then the bad news we've seen is probably baked in, and we might even see a rebound at some point in the future. If things got even worse than we predict, then yeah, it certainly can get a little worse. I just want people to remember that it's not like isolated in a vacuum and we don't even consider what might happen in the future. So that's lesson one. Real quickly, this one's maybe even more important. The price of the stock market is not the value of the stock market, okay? So imagine you had a stock that had $5 earnings per share. It had what's called multiple of 20. So you get a stock price of 100. So imagine if the stock goes to $120 a share. It's like, wow, the stock went up 20%. Look how expensive it's gotten. But that's not really how it works. Because what if the company did really well and its earnings went from $5 a share to $8 a share? Well, guess what? Now the multiple is only 15. Look, that's just a fancy way of saying this. Even though the stock's 20% higher, it's actually cheaper than it was before. And so the reality is earnings have been fantastic the last couple of years. And now with the stock market pulling back a little bit, you're actually looking at a stock market that's 25% cheaper right now than it was a couple of years ago. So hopefully that gives people a little bit more breathing room to kind of understand that it's not just kind of the price, but the company's earnings are doing well too. And that matters.
So, Brad, what does this mean for people? You know, what does it mean for them right now? What does it mean for them moving forward? We got about a minute left, but people want to know, what do they plan for at this point?
Well, look, interest rates matters a lot. When interest rates rise, that pushes valuations of the market down, right? If you can get a 10% CD somewhere, you wouldn't invest your money in stocks. So just remember that basic principle. Here's the whole key. Again, I'll do it in the next 30 seconds to your point. The Fed is trying to thread a really tough needle right now, because everybody's worried about inflation and everybody wants this inflation to stop. So guess how you neutralize inflation? You raise interest rates. But when you raise interest rates too much, it lowers some economic activity and it can put pressure on the market. So how do you thread the needle of not going into recession, of not tanking the market, but neutralizing inflation? We had a bad first quarter. Unemployment is at 40-year lows. Earnings are really good. We just really have to be worried about inflation. Here's the main final piece of this, Carlo. I know we're running out of time. Be a long-term investor. Have a diversified portfolio. Don't risk money you need in the next 6 months because anything can happen. But over a 5 or a 10-year period, you will always look back at moments like this and be thankful you didn't panic and deviate from a good long-term plan.
I just like hearing from a professional. I know that it's something is gonna help me in making my planning. It is a tough, very complicated thing to work out. Brad White, Senior Wealth Advisor. Appreciate your time as always. We'll talk to you soon.
You got it.
All right.